Hello, everyone. Welcome, welcome. Today is Tuesday, March 14th, and we are here today to talk about smart investing strategies. So excited today. This is our most well attended one yet. We have apparently 158 attendees signed up for today. So this is wonderful that everyone is joining and able to jump in with us. So let me begin as usual with our disclaimer, as we're required to do by compliance. The information in this material is not intended as tax, investment, or legal advice. Please consult a professional for specific information regarding your individual situation. All right, and with that said, let's get started. Today we have one of our portfolio managers that works with us and our clients. David Mara is here, so I'd like to introduce him. David Mara is the co-founder and managing director of Markin Asset Management. Markin is a systematic multi-asset specialist based in Rye, New York. Their funds and strategies appeal to clients seeking superior long-term total net return and capital protection in times of stress. David has an eclectic background. He leads research and portfolio management for Markin and has been an invited speaker on quantitative asset management at numerous family offices, hedge funds, and conferences. David received an MBA from the University of Chicago Booth School of Business, where he was a fellowship recipient and was fortunate to have had several lecturers who have received the Nobel Prize in Economics. He's been a principal with Boston Consulting Group, a founder of two artificial intelligence firms, and early in his career was assistant to Japan's former Minister of Defense. So without further ado, I will bring David Mara on to work with us today.
Hi, Marcus.
Hey David, how are you today? Happy Tuesday.
Happy Tuesday. It's nice
Yeah.
to be joining your podcast today.
Oh yeah, thank you so much for taking the time to join us. As always, you keep us and fellow advisors up to date on what's going on. And so I just thought it prudent to bring you on. They can kind of see people we work with and things of that nature. It's really helpful for our audience. Um,
Absolutely.
yeah, so thanks again. So I'll get started. I'll get the presentation started, and we'll work through our PowerPoint slides here and go through. So audience today, what we will work on is one talking about just some basic investment principles, market timing, asset allocation strategies, and investment selection. And then David will also take us through kind of post-COVID uh, things that have changed from pre-COVID and how we used to invest and how things we look at things. We'll also talk about last year in particular, 2022, where we seem to really see that correlation between stocks and bonds moving in the same direction. I'll have a slide up about that and what happened. And then we'll kind of let David kind of take us through 2023. What's the outlook for rest of the year? What are things we're paying attention to? And we'll kind of work through that. So it'll be very interesting and hopefully very informative for everyone. So again, today, smart investing of principles is where we are talking about today, and we want to start out with portfolio. I want you guys to take a few minutes to look at this portfolio. Won't keep it up here too long. But we've got four portfolios here, A, B, C, D. We're showing you some returns, year one, two, three, four, and five. And we give you a little cheat sheet on the edge with the average of how these portfolios did. So the question is, which portfolio do you want to own? A, B, C, or D? So I want you guys to take a look at that, get an answer, and although I won't talk to anybody individually, I'll be interested to know at the end of the presentation if you have the same answer as you did when we started the presentation, and we'll come back to it with the answer at the end. But that will get us started. So again, a couple principles we're going to talk about: time in the market, asset allocation, and investment selection. So as we get started, time in the market. David, see it time and time again. I had a conversation with a client today, said she stopped investing in her 401k because the market wasn't doing well. And of course, I talked about the emotional aspect of that, in that that's common, that fear, greed, and market timing, we tend to, as the slide shows here, buy high and sell low. Um, what would you add in terms of market timing and time in market and things that occur when we kind of try and have that approach?
So I do think it's useful to kind of separate out what the individual investor should do as they're saving for their retirement and other needs versus what an investment manager like I tries to
Hmm.
do for clients because they're separate. For clients, obviously, there's a an aspect of certainly trying to buy at a price that we believe is well valued and that will go up in value. But for the individual investor, and including myself as an individual investor, um, the best policy, I believe, is to consistently invest, right? We don't know when. In fact, nobody really knows when. Even professionals don't know. We may know how to react to a market that's going up or a market that's going down from a risk management perspective. But nobody knows, as you're pointing out, how to time the market in the sense of, I know the market's going to go up over this period of time and then go down over that period of time. That's
Correct.
extraordinarily difficult, right? The market is very, very efficient, and all my professors at Chicago told me the markets were very efficient and have good data to show that it's very efficient.
Absolutely.
So, the best policy, I think, for the individual investor is to consistently invest the prudent amount that will get you to that retirement income that you desire. And obviously, your financial advisor can work out a monthly schedule that kind of shows you whether you're on track or not. But just coming back to it, I think the best policy is, and it's the policy I've always used in my own saving, is every month when I get paid, I have a certain amount that goes in. That consistency
Hmm.
really benefits you over the long term. It prevents you, and the reason why, the logic for that is the reason why is it prevents you from uh, uh, chunking up your money into what might be suboptimal times for the market, right? Much better that you're in a little bit every month or whatever your schedule is, if it's quarterly, and therefore you're not creating any bias in your portfolio that could bias your returns downward.
Yeah. So yeah, like I said, I think that piggybacks on the next slide here, which kind of is an illustration of 20 years worth of data and showing when people miss the market and they miss the best trading days. So if you missed 5 of the best trading days, your return went down, over 2 points. You missed the best 10 days, we're down at 4, and you missed the best 20 days, you're at 1.57. So that, kind of lends to what you're saying. The consistency is what breeds the performance. Because there's no way for us to do that and perform it on a consistent basis.
Right.
Right. Absolutely. Now, one thing I probably will say though is when there are times when someone is probably has some sort of type of short-term goal. um, the biggest issue I see most times is I'll get a question, when should I get out? And my answer to that normally is, what's your goal? And the problem is most people haven't set a goal. They invest and they don't know when to get out because they don't have a goal. So my thing is, set a goal and you can't look back. Because just as well as you can say, I could have made, you can just as well say, I might have lost.
Right.
Yeah. So I think that's an important key point that we try and make with clients as they're setting, short-term goals over a certain period of time.
Right. I mean, the common short-term goal that, and you deal more with individuals than I do, Marcus, but the common short-term goal that I often see is people saving to buy a house, for example, right?
Hmm.
So it's a very large amount of money, and they might say, over the next in 5 years from now, I want to buy a house. And 5 years in the scheme of things, or it could even be shorter. A year from now, I want to buy a house. The shorter that time frame, as Marcus, as you're suggesting, you really need a plan for that, and a very carefully thought out one, because who knows what markets are going to do or your investments are going to do over that short time frame. And if you really have a desire to do that at that date, regardless of what's going on in markets, obviously you're gonna. I'm sure somebody like you, Marcus, a financial advisor, is going to advise them to be conservative over that short horizon, so that they can make sure there aren't losses, and if there are, they're very small.
Yeah, absolutely. Um, so that leads in perfectly into the next thing of asset allocation. And and here we have a chart again showing, research has proven that we're around these numbers. They may not be exact, but they're pretty close. That 91.5% of our performance is determined by asset allocation. The other 8.5%, there are other factors. Um, I know you and I, one reason I gravitated to marketing to help my clients in their portfolios is we take a little bit different approach, and we more see ourselves as risk managers first and not chasing returns. So how could you kind of correlate those two things together of the risk management aspect of investing and how it kind of relates to this asset allocation that we're
Yeah.
trying to achieve as well?
Yeah, thank you, Marcus. I think that's a great slide to put up, and it's an important lesson for everybody who's listening. Um, Another way to state this slide is that markets are highly efficient micro-wise. Micro-wise means individual stocks are often well priced. Markets are, and there are some famous economists who have observed this, and markets are inefficient from an asset allocation perspective. So what that means is that um, the better you can well diversify and establish an asset allocation that fits with your objectives and your needs, the more likely you are going to be able to achieve them, right? Guessing what stock is going to go up tomorrow, and that's a very, very difficult game because markets are so efficient. We can actually do better on a relative basis if we take an asset allocation perspective. And so, Marcus, thanks for putting this up. Typical asset classes are fixed income, stocks, bonds is fixed income, cash equivalents, another version of fixed income, but the cash part of it, and then speculative investments. Often we hear things like private equity, venture capital, those type of speculative investments. And we take the position that, you know, I'd put it this way. I think when Gene Fama won a Nobel Prize, Chicago economist won a Nobel Prize about a decade ago or so, when he was always asked, what is the best investment strategy?
Hmm.
Uh, He'd always answer, well, that depends on your preferences, right? As you
Correct.
were alluding to,
Absolutely.
Mark, depends on your preferences for risk, primarily for risk, right?
Right.
Return is a function of risk. So the way that we as portfolio managers think about things is not what return I want to get. That's just a
Hmm.
function of the risk you take. So you need to first think about, well, how much risk does my plan allow for? How much risk am I emotionally set up for?
Hmm.
If markets drop 30%, am I going to be out of there
Right.
and then miss the upside, right? So we all have a preference, and nobody's
Correct.
preference is right or wrong. It's the preference for you. The trick is working with an advisor or other professional or using other tools to find how that risk preference that
Hmm.
you have then translates into, okay, these are the best investment vehicles that then capture that risk preference. So you ask Marcus, kind of like what we do. We have multiple portfolios, like many other
Correct.
asset managers. We have multiple portfolios, each one targeting a different type of risk.
Right.
And that allows you as an advisor to work with an individual and say, okay, that's their risk preference, and then this is that they're the best portfolio that fits that risk. So that's how we kind of think about it.
Yeah, absolutely. I know your website kind of mentions some key principles, and one that you and I both are dear to our hearts, I think, is first we're trying to avoid large losses, because it's so hard and difficult and time sensitive to recover from those. Um, so that's where the that risk really comes into play, and the measurement of, as you and I talk, we kind of venture out. We won't be geeky here and get into sharp beta and all that fun stuff. Things that you and I are like beating over the head. But those things are where we start again, because we're trying to conserve money and get you to your goals in the most efficient way, tax efficient way, and cost mannerism.
Yeah,
Yeah.
and this conversation reminds me of a quote from Warren Buffett from years ago, but he said, the best way to compound wealth is to avoid large losses.
Yes.
And that's absolutely true. It's
Hmm.
absolutely true.
Hmm.
And we avoid large losses not by leaving the market, as you pointed out. You don't want to leave the market. What we do as asset managers is we help clients avoid large losses by moving into safer asset classes, as you were talking about. It's all about asset allocation, right? So moving into safer asset classes, um, uh, so overweighting, what we call in the industry, overweighting safer asset classes
Hmm.
um, when times are really risky,
Hmm.
uh, and embracing riskier asset classes when times are really safe. And the net
Hmm.
net of that is when markets get risky, but you get a little safer, and vice versa. When markets get less risky and you get to take on a little more risk, the net of that is you end up staying right where your risk preference is, right where your long
Hmm.
term risk preference is. So you're not really moving up when the market goes up, and therefore you blow past your risk preference, nor are you, when the market is really safe, are you just dropping down and not getting any return. The idea is if you've signed up for a particular risk preference, we just want to kind of keep constantly within that. But to say
Correct.
constantly within that range, because markets are moving, we have to move in kind of in the opposite direction. And that's how you can deliver what Gene Fama talked about, or what most people care about, which is their preference. They're comfortable where they're comfortable, and try to keep
Correct.
consistent with that.
Absolutely. Absolutely. Awesome. Awesome. All right. So, yep. So that's our background on the principles. So let's kind of jump into maybe some things that we've seen over post COVID, and things of that nature. So we're kind of getting into this investment selection, and a little bit about too, if you can help us understand. Now, again, you won't go in as of depth as you did with us in the financial planning when you spoke to us at the Financial Planning Association, where you had multiple graphs and we got really granular with this data. But you were able to kind of show us how what a lot of people have heard, as a regular 401k participant, we hear 60/40. We should be 60% stock, 40% bonds. Your data showed how that's changed over a period of time.
Yeah.
So if you could kind of, yeah, share with the audience a little bit about how that's changed, and then specifically, I think post COVID, how that's changed.
Sure. So if we look at, one of the approaches that I like to take is to look at things over a very long period of time. And because we can learn more. Each cycle in finance tends to be long. We've been in one long cycle really since the late 80s. I mean, these cycles can be really long, 30 years. We have really good data for about 120 years in North America, good equity and bond data. If we look at that whole 120 years, what we observe, and talking about kind of two asset classes, 60/40 is bonds and equities, bonds and stocks.
Correct.
And if we observe that, we'll see that we can go for, as we did back in the 1920s and leading up to the 30s, 19 teens, 1920s, all equity was the best portfolio to be in. Then 1930s, all bond. Then post World War II, through the 50s and 60s and 70s, if I remember right, about 4 decades, all
Hmm.
bonds was optimal. And then it came down again and went back up again. So there are periods in which the optimal portfolio is very far from the typical 60/40 portfolio.
Hmm.
And by holding that 60/40 portfolio through those periods when it's optimal to be all bonds or
Hmm.
all equities, uh, it's not that you have to hold exactly all bonds or all equities. We don't recommend that. But if you're just holding a static portfolio that's always 60/40, regardless of what's going on, you there's a lot of destruction of value. So, for example, the maximum drawdown in that period from the 1920s teens and 20s leading up to the 1930s, the maximum drawdown on a rolling 10-year basis of the 60/40 portfolio was over 50%. And all of those periods that I mentioned, the 1980s when it was optimal, to late 80s, 90s, 2000s when it was optimal to hold mostly equities. Um, the maximum drawdown of the 60/40 was in excess of 30%. So the lesson from that is if we're far from optimal, we don't have to be exactly optimal. What if we're far from optimal? There can be a big price to pay.
Hmm.
And sorry, we don't have the slide for that today, but it's quite
No, no,
compelling
no.
data. And so what we want to do, the lesson is you kind of want to lean into the business cycle, right? These cycles are really the business cycle,
Hmm.
and you want to lean into the business cycle and evolve your portfolio over the course of the business cycle. And therefore, it's about finding the investment products. Nobody's suggesting here you should do this yourself. You're busy, you have a job, but finding the investment managers and wealth managers, who can, people like Marcus, who understand this and have selected the right investment managers that are guiding those portfolios
Hmm.
over the business cycle and evolving them so that you get so that you have the right, what we call tilts in your portfolio. You're tilting a little bit toward equity, you're tilting a little bit toward bonds when it's right to do so for the portfolio. In
Hmm.
that way we can get back to Warren Buffett. We can that will help avoid those large drawdowns and ultimately produce over a long retirement more total yield, more capital appreciation, and more dividend payments.
Absolutely. Awesome. Awesome. Now let's get a little closer to last year, 2022. I didn't get the fourth quarter data, but I did have this data from a presentation that I attended where fixed income and stocks kind of moved the same direction. You know, people were calling, "Hey, I moved everything to fixed income and my 401k is still going down." Um, so kind of again, let's educate the clients on maybe 2022 and what specifically happened in 2022 that just made that such an anomaly and that everything was going same direction.
It really was, Marcus. I mean, you have to look through a lot of data to find, and there are multiple periods of time when it's been true, but you do have to look through. There aren't that many points in time in history, that
Hmm.
many cycles. I can think of maybe three major cycles where um, bonds, and as you pointed out, bonds and equities were highly correlated with each other, whereas they're usually negatively correlated. One goes up, the other goes down. That kind of protects your portfolio. But they were both correlated on the downside. And they both had, and the other aspect of it, not only were bonds highly correlated with equities, which is undesirable property for bonds, but also um, the volatility of bonds was
Hmm.
very similar to equities, which we don't expect at all, right? There were points during the year, in fact, most of the year, when bonds were down as much in a percentage basis as equities were. And there were points in which bonds actually led equities and were down even more. So to have, typically we think of bonds as being much less volatile, and they typically are, than equities. So last year had two big distinguishing characteristics in which that bonds and equities were correlated and they had a very similar volatility.
Hmm. Absolutely. Yeah, it was really, really strange. Like I said, there were a few data points where it has happened multiple times, but I think last year was the first year it was 3 quarters in a row where we experienced that, and it was just very difficult environment for people. Um, Very difficult. All right, so we've kind of gotten through the past. Let's kind of come to the future here and where we are today. I put up the sticky inflation because we talked about that in our first quarterly meeting in March. And last year, I mean not last year, last week, I'm on the treadmill reading an article and I see sticky inflation. Person I thought about was David said something about sticky inflation. And these are things I have on the slide are things that we talk about with David and Matt. Matt's not on the call today, but this has been our world, I think, for the last year is inflation, labor cost, housing, what's going on with housing, and then the interest rates. And that's kind of what we've been looking at for the most part to kind of guide us. So as we're in 2023 where we are first quarter ending up, kind of what do you see? I know you've shared some stuff with us as advisors in terms of housing, what you see there, or what Goldman Sachs sees there. Read a lot of their data. Labor costs, as we've talked about, is expensive just to go to Chick-fil-A and get a Happy Meal now or whatever they serve. So yes, as we move forward, what can you share with us regarding 2023?
So this might be a little bit disappointing to hear, but we're still in a very highly, uncertain environment. And even if we look back at professional forecasters in the last 2 years, pretty much everybody's been wrong. I mean, there are a few out there you can find. There's always somebody who was right in retrospect, but it's a very, very difficult environment to forecast in. And it remains a difficult environment. Uh, we're in an elevated inflationary environment, which we haven't seen for 30 years plus, and and there aren't a lot of data points on either high recessionary environments, even if we look over that 120 years,
Hmm.
or um, uh, uh, high interest rate environments, and we
Hmm.
don't have that many data points on recession. I think, in the correct me if I'm wrong, but very roughly in the last 60 years, I think we've only had 6 or 7 recessions. I think it's
Hmm.
6 in 60 years, if I remember right, something like that. So it's a very small number of data points for the
Hmm.
type of environment that we're in. So it remains extraordinarily difficult. Um, uh, uh, the Fed is, I believe, really, really committed to getting inflation back close to 2%.
Hmm.
And that means that likely interest rates are going to remain elevated for a while to get that down. And the reason why is inflation destroys a lot of things for people. It destroys their savings, it destroys their incomes, their salaried incomes I'm talking about, right? So, and it makes making financial decisions much more difficult for businesses. It's more difficult to make a capex decision in a high inflationary environment. So the Fed has lots of reasons to want to get inflation down, and that's going to mean holding it higher for an extended period of time. The only thing that could really bring interest rates down quickly um, would be a recession, right? If we had a recession, the Fed would ease off. But that's not a good outcome either. I think it's a better
Right.
outcome for everybody if we don't have a recession, or we have a very light recession, and we live with rates for a little higher for longer. So this then I'll stop there, Marcus, because you might have some follow-up questions. But yeah, there's lots of implications of that.
Yeah, no, that's kind of what I was reading here recently too, in terms of, like I said, there's not a lot of data, and one of the articles I was reading was stating that is there any enough evidence that says 2% or 2.5% inflation, what's the impact? And there's just not enough data to kind of say what happens, and is it worth, like you're saying, wrecking the labor market to get to this point? It's a very tough seesaw to be on.
Yeah,
Um,
yeah, and you've heard me say, Marcus, before. I when I think about inflation as a phenomenon, right? Because it's just good to understand what is inflation as a phenomenon. What are the characteristics of inflation
mhm.
based on what we know? And we actually economists know less about inflation than almost any other economic phenomenon,
Right.
right? They know good things about GDP, for example. They know good
Uh-huh.
things about productivity, for example. Inflation is one of the unforecastables, right? It's like for those data reasons I mentioned, and a variety of other reasons.
Right.
But what we do know about inflation, at least historically, is that inflation on the upside is like a jackrabbit. It pops up out of nowhere and it comes up really fast,
Mm.
right? When we
Mhm.
look at all the histories of inflation before, it really does rocket on the upside. I call it a jackrabbit. On the downside, again, the
Mm.
historical, that 120 years that I talked about, where we have had inflationary periods, it's like an elephant on the downside,
Mhm.
where an elephant has a lot of momentum and it takes a lot of effort to slow it down, and it takes time.
Mhm.
So
Mhm.
you get something like this
Mhm.
with inflation. And I think if we just take that as a phenomenon, uh, uh, the reason one of the reasons why the Fed is trying to act so quickly and raise rates at a historically fast pace is because they know this, right? They know that
Right.
inflation takes a long time to come down, and therefore, the higher it goes, the longer it takes. So prevent it from going any
Mm-hmm.
higher. That's the whole dynamic that's going on here.
Right. Right.
Because I mean, there's really even nobody forecasting that we get back to 2% in even by the end of 2024.
Mm-hmm.
So we're going to be in an elevated,
Mm-hmm.
lower, hopefully much lower, than
Right.
we are
Right.
now, 12 months from now, but still elevated inflationary environment for the foreseeable future.
Mm-hmm. And then that's kind of what they were talking about in terms of it being sticky, that we're trying to come down, and the elephant, I guess, is kind of stuck, and
Yeah,
maybe ate some more food or something, and now
right. So
he's
you're kind of coming up, and the jackrabbit has popped, and then you do get the turning point. And we had a turning point, we've had a turning point now a
yeah,
couple of months ago, and it starts to
correct.
come down, and everybody starts clapping, and there's euphoria. It's turned. We've hit peak. It's coming down, and it kind of the first couple of months it kind of comes down pretty quickly, and then
Mm-hmm.
what Marcus is referring to there, you hit that stickiness,
Yeah.
and you've taken off the froth on the top, which was the easy part, and now you're at an inflation rate of 5% or 4%, and it gets really sticky is what the data
Mm-hmm.
shows. And getting from there down to 2 is really
It's,
hard work.
yeah. Gotcha. Gotcha. Awesome. Awesome. All right. Well, great. Well, we will kind of finish on this note. I want to talk about the volatility tax, and here we go back to our where we started with our initial portfolio. So hopefully you all had an answer. I'm not sure if your answer changed after hearing most of this, but again, we'll kind of have this up. I'll put up the answer here in a second, and then have David comment on that, and we'll end up. But again, so we had these portfolios, different sequences of returns, different. You know, D here is up, down, all over the place. C is kind of consistent. I mean, I'm sorry, B. C is kind of up and down a little bit, not as bad as D. And A is kind of up and down and not as bad as C. So we've got these average returns over here, 2.6, 2.8, 4.2, and 6.4. So drum roll, please. Here's our answers to the question. Um, the best portfolio in this scenario, this 5-year window, was portfolio B. Reason being, it has the highest compounded return and therefore the highest ending value, but also it has the lowest gap between the average and the compound. So, David, can you share with us that phenomenon in, I guess, regular people's talk as to what happened here with these portfolios?
Yeah, sure. And 5 years, it's a short period of time, and
Right,
so everybody should consider that.
right.
But uh, uh, I, I I think the most important thing, I guess, we're kind of ending on this, is uh, you do want to work with an advisor and really run the numbers. And I think the view the running the numbers to me means really understanding the risks and the horizons over those risks and whether you can do that. So portfolio D, if I remember right, had some large drawdowns, if I remember right. And am I correct in that, Marcus?
Yeah, let me go back. Here you go.
Yeah,
See.
there we are. Right. It's got some big drawdowns, 30%, 22%. It's got the highest compounded number. But the question is, over that 5-year period, did I need that cash? Or was I young and I'm just purely saving
Mm-hmm,
and I didn't need to touch it? If you're in that category where you're purely saving and you don't need this money for a long period of time, portfolio D might have been a good
mm-hmm.
preference. You got a
Correct.
risk on preference. I think if you were in a different stage of life and you're actually drawing that portfolio out, you're going to get a very, very different answer. A portfolio like A
Mm-hmm,
or B, is going to look a lot more competitive if you once you run the Monte Carlo simulation, because you've got needs. You've got needs to write a check to yourself every single month from
mm-hmm.
that portfolio. So when we talk about preferences,
Right.
we're including needs in that, right? We're including
That's right.
needs in that. So that would be my observation about these portfolios.
Absolutely, yeah. I think the thing was, trying to highlight maybe the just the fact of the need to do that. and where are you in terms of a need for income and things of that nature. And you can say all of are close. It's not like one of them ran away over the 5 year period, but still, as David is saying, it's depends on where we are. Um, of course, we don't want portfolio D if we, like he's saying, just entered retirement and we're 65, because that 30% loss is hard to kind of come back from. So it's the same thing we talk about with with our retirees, um, where maybe if I've got a retiree retiring in a down market, we maybe take less income because we're trying to conserve it versus a retiree who's retiring in a flat or up market, because we have more resources to work with. So, you know, as David said, those are all things we consider. For me, I have a lot of clients that, and I tell clients, I'm not going to be the fastest because I have to I got to get this on a sheet of paper first as to where we're going with you. And again, taking the appropriate amount of risk to get you where you need to be. Maybe we don't need to be a 80/20 if we can get you to your goals on a 55/45, whatever that may be. And that's where we're able to communicate with David and his team and say, hey, this is my client just needs a conservative portfolio here. We're trying to get this amount of income off of it. This is what we're trying to do. So we're doing a little bit more than just 50/50 and 60/40 and 70/30. It's what do we got to do for this particular client? You guys have been able to help us tremendously with success in our client portfolio. So,
Well, thank you, and it's a real pleasure working with you, Marcus.
oh yeah, I've definitely enjoyed it, and the information you share, we're always in a learning environment. So I soak it up and pay attention, and it definitely comes forefront. So, again, thank you for joining us today. Um, All right, everyone, we will wrap it up for today. We've got three more coming up over the next every other week, as always, kind of going into our retirement series next. So we look forward to everyone joining. And again, if I can ever be of assistance to anyone, please reach out. Love to have it. David, again, thank you. Signing off. I've already talked to Matt. I've got to call him tomorrow on some clients, so I'll be talking to you.
All right, Marcus, take care.
Thank you, buddy. All right, y'all. I'm gonna end this stream. Talk to you next time. All right, everybody, enjoy your week. Take care. Bye bye.